Hello and welcome back to the ROI Podcast, the Return on Investment podcast. And he's back. We have a very special guest today. Guys, make sure you like and subscribe to help out with the algorithm. And if you haven't already secured your spot for the Natural Resources Investment Symposium, join us this July. The link will be in the description. Rick, thank you very much for coming back and joining me. Thank you for inviting me to Boca Raton for the symposium. I'm very excited. Perhaps just give us 2 minutes as to what I and the other attendees are going to learn at the conference and who are we going to learn from?
Well, it's interesting, the last question, who you're going to learn from. We've been doing the conference for 30 years, and there's a great core of returning investors, both online and live. The idea that all the knowledge in the room emanates from the dais to the audience is wrong. So first of all, you're going to mix with fellow investors who've been in the game for a very long time and are very well educated. I encourage you to talk to people in the bar, talk to the person sitting next to you, talk to whoever you can, because there's a lot of knowledge in the room. Formally, however, a few things have characterized the conference over the years. The first is that most of the big picture macro thinkers we have aren't journalists. They aren't commentators. They are people whose observation of the levers of power come from having pulled them. Our keynote political speaker this year will be David Stockman, who was the head of the Office of Management and Budget in the first Reagan administration. You are too young to remember it, but Reagan actually had a landslide victory on the promise to reduce the size of government. David Stockman was the one in charge of doing that, and he wrote a book detailing the derailment of the Reagan Revolution by politics in 6 short months after inauguration. He's written a recent book called How to Cut $2 Trillion from the U.S. Budget. The reason I bring this up is because this commentator is a commentator from the belly of the beast. He talks about cutting the federal budget because he was in charge of cutting the federal budget. We have Daniela DiMartino Booth, who will talk about the Fed. She talks about it because she was a researcher at the Dallas Fed. We have Nomi Prinz talking about the structure of Wall Street. She talks about it not as a journalist, but rather as a partner at Goldman Sachs. You get the picture. Jim Rickards will talk about the leverage structure of Wall Street from experience because he was general counsel at Long-Term Capital Management, which damn near brought down Wall Street. After we've given you a big picture view of the world, the kind that in Australia you would not find on ABC, or here you would not find on MSNBC, we move on to analysts and portfolio managers, not people who failed following crypto or consumer durables or pot stocks or tech stocks, but rather people who have made their living on the front line investing in commodity-centric and precious metal stocks for 3 decades and 4 decades. Beyond that, of course, we have the living legends, entrepreneurs who built multi-billion-dollar natural resource companies from scratch, telling you how they did it, what mistakes they made, what mistakes you make, and how to get it right, helping you identify the budding entrepreneur with a $25 million market cap that is on his or her way to a $5 billion market cap. At our conference, unlike every other investment conference I know of in the world, our exhibitors are content too. At every other conference I know, the qualification to be an exhibitor is simply a check that cashes. At our conference, in order to be an exhibitor, you have to be owned in an account owned and managed by me. No guarantee, sadly, that because I own a stock, it goes up. But there is a guarantee that because I have to own you, I have vetted you. Absolute positive guarantee that that is true. Finally, the last guarantee. Unlike any other investment conference in the world, if you attend the Rule Symposium, either live or via live stream, 2 things. You'll have access to the full conference recordings for a year, and you'll need them because we're going to give you 50 hours of programming in 4 days, more than you can absorb. But the other guarantee is maybe more impressive. If for any reason you don't think you got your money's worth, I'll give you your money back. There's an absolute solid gold money back guarantee. The financial risk of attending my symposium, either live or via live stream, is nil. I bear all the financial risk.
Well, it's an all-star lineup, and thank you once again for inviting me. I can't wait to take part in person. Topic today, Rick, that's been on my mind is investing across a full or multiple business cycles. Now, this seems to be crazy to a lot of people who are addicted to the 24-hour news cycle. Wall Street, private equity guys that have got to get their stock issuances, performance fees done by certain dates on the calendar. I've been thinking about this idea of the equity yield curve, much like a bond has a different yield curve depending on the year to maturity and the price. Equities, I find, if you can go out just past that 12-month Wall Street calendar cycle, really start to change in terms of their earnings and valuation profile. The trick is, how do you get yourself to think and act in long term, let's say 3 years plus? And I wanted to ask you, what have you found helps you just get your focus back on track? People think 3 years is a long time, but that's where I see all the inflections happening on this idea of the equity yield curve.
Benjamin, I'm laughing because when I was a young guy and I had lots of time left on Earth, I was impatient. Now that I'm an old guy and the end is drawing nigh, I'm much more patient. It isn't because I wouldn't prefer immediate gratification. It's because I've been investing for 50 years. I've been through 10 5-year cycles. What you learn as you invest is that what you want is irrelevant. You have to adapt yourself to what you can have. The eighth wonder of the world and the first wonder of the financial world is compounding. And you can't compound between now and a long weekend. It doesn't work that way. If you can wrap your head around the fact that equity investing is really about buying fractional ownership of good businesses, and you regard the market not as a subject, but rather a facility for buying and selling fractional ownership in businesses. And if you think about how long it takes for a business to prove itself, then by nature, you become a long-term investor. I've said in your interviews, you may not recall them, but I do, that the key to successful speculation is identifying the principal unanswered question, figuring out what a yes answer would be worth, figuring out how much time it would take to accrue a yes answer, and how much money it will take to get a yes answer, and then accommodating your time frame with the time frame necessary to get a yes answer. Real money is made by, after you get that first yes answer, if you do, asking yourself what the next unanswered question is. For me, as a speculator, when I looked back at every 10-bagger that I could remember in my portfolio, going back 50 years, what I learned is that the median elapsed time to enjoy a 10-bagger or better was 5 years. And by the way, almost every 10-bagger that I enjoyed, I experienced a 50% price decline at some point in time that I held it. So in addition to being patient, you must be tenacious. Most new investors are neither patient nor tenacious. And if the fact that they lack patience or tenacity, that fact often causes them to become ex-investors. The process that you talk about, which is to equate a company with a bond, but a bond with a potentially rising yield, is precisely the dogma that has been taught by Warren Buffett. And he's been a strikingly successful investor, simply because he regards the market as a facility rather than a subject.
Wise words indeed. And in that first order, that first wonder of the financial world, compounding, I'm loath to interrupt the compounding by selling, but I know that I'm my worst enemy. So I look out and I think, what are some things that are going to give me some comfort in order to allow my capital to compound? And this is where I really started to change from being a dyed-in-the-wool value degen into looking at higher quality business models that during a few bad years will still continue to do well. And that's where I ended up really going all in on the royalty strategy. There's another hard asset interest but capital light business model. It seems to be hidden in plain sight, and I've never heard anyone ask you about it. And this sector, or this type of business I'm referring to, is a financial exchange. The capital light, volatility beneficiaries, high margins, etc. How do you view, let's say, the CME, International Intercontinental Exchange, etc., in terms of assets in the marketplace?
In the 90s, I was a buyer of exchanges. It seemed to me that the easiest way to participate in an emerging market, by the way, as an example, was if their exchange was public in the exchange. It gave me a proxy on the society, but a higher margin proxy. And that worked well. The difficulty was that it worked too well. I'm a net present value guy, and the multiples that began to be assigned on exchanges exceeded the multiples that I was comfortable to pay, and I sold them. That turned out to be a mistake. The world didn't care very much about the multiples that I thought was appropriate to assign them and paid more attention to the multiples that they thought appropriate. But making some money is better than making no money. And I agree with your thesis. Exchanges are able to do wonderful things now. They're able to extend their franchise electronically past their political boundaries. They're able to use technology to lower their internal clearing costs. They are able increasingly to develop specialized exchange-traded products, even the exchanges themselves, indexes, equity options, things like that. The next frontier, nobody's been willing to do it yet, is exchanges that are 24/7. There's no particular reason that just because the jobbers and the floor traders go to sleep, that the market ought to go to sleep. I suspect within 5 years, you'll see 24/7 exchanges. I also expect within 5 years that you will see the clearing and settlement apparatus begin to disappear, because I think that you'll see exchanges that fractionalize all kinds of assets and trade them on the blockchain, the distributed ledger. And I think the tokenization of financial assets, the elimination of the clearing function, the increasing internationalization, evidence as an example by interactive brokers, and then the adoption of blockchain technology means that exchanges are headed into their truly golden years.
Indeed. And especially if you think about higher and more volatile inflationary times ahead of us, and sovereign wealth funds, etc., will need to use more and more derivatives as a hedging function. It almost seems like unless there's, God forbid, a war and they have to close the exchange, if there's any type of activity, these guys, as the financial croupiers, will seem to take a clip out of all that activity going forwards.
What's happened just in the last 5 years, even an old inadvertent Luddite like me, who isn't particularly facile with technology, can open an account with interactive brokers, and I can trade Indian stocks in India. I don't need to trade their depository receipts if they're available in the United States, or Indian stocks in places like the Dubai International Financial Exchange or London. This ability that even fairly incompetent technical people like me have to participate in domestic markets almost as a domestic investor is incredible. That comes on top of the circumstance that you're describing, where institutional players could take advantage of derivatives based on the activity of thousands of investors like me to smooth out their own performance. Really interesting times.
Indeed, they are. So do you own any exchanges or trading houses at the moment? There are some super interesting ones that have been rolled up, like the Minneapolis Grain Exchange, which is hard to get direct access to, but I've got a way I think I can play it. Do you own any?
At present, I own no exchange stocks. In the financial services industry, the smaller U.S.-based property and casualty insurers and the U.S.-based commercial banks community banks, are so cheap that I haven't seen any need to go out of an area where I have a durable competitive advantage. These are businesses I understand, often run by people I know, and some of them are really, truly felony cheap. And I haven't had the need to go out of my immediate area of expertise when the valuations in my immediate area of expertise are so laughably cheap.
Well, that makes sense. Are there any particular names, publicly traded names, that you feel are cheap at the moment in that space?
Given that I'm on the bid,
Okay.
probably not. I Some of the larger names that one could look at, not hardly the little ones that I dabble in more, but in the insurance business, both Chubb and W.R. Berkley are pretty cheap, and they're wonderful franchises. Uh, One way to look at them would be to consider them to be bond portfolios with a sub-zero cost of capital. I say that because both of those companies have positive underwriting margins, which is to say that they pay out less in claims than they take in premiums. The uh, unpaid, the the surplus of the premium over the payout and the tax deferral is called the float.
Mhm.
This float is neither debt nor equity, but it can be invested in income yielding instruments. So, as an example, if you're getting a 5.5 or 6% yield on a bond, and your cost of capital is -2, your 5.5 or 6, let's say your 6 becomes an 8. And more importantly, if you're somebody like Berkshire Hathaway or Chubb, you set very large policy loss reserves. You set reserves for claims experience that exceed your actual claims experience, and the regulators want well-capitalized insurance companies. What all of that means is that if you're getting an 8% yield, including the negative cost of capital, and you're deferring tax on the interest payment, you, you, you have a pre-tax bond portfolio with a zero cost of capital. It's a wonderful play, wonderful way for an old guy like me to have a bond portfolio managed by other people with a negative cost to carry.
And certainly some compounding potential that goes along with it. You have experience in financial services, insurance, and also real estate. I look out briefly, a cursory glance at the US housing market and particularly the US real estate brokers. And there's a few that I would view as being extremely cheap, the likes of Remax, for example, which is about a third of its book value, less than 20% of its price to revenues. Douglas Elliman, it's slightly less cheap, but it's got big tailwinds. Is that an area that you've invested in the past, where it has access again to a hard asset, but with a capital light business model?
The answer to that question is yes. If you asked a question if I'd invested in it successfully, then the answer changes to no. um, I tend not to have a lot of patience with themes that I don't feel I have a competitive advantage in. I have successfully invested privately a couple times in capitalizing agencies, insurance agencies and real estate agencies, where my compensation was a royalty on their gross revenue. I didn't have to pay too much attention to their accounting. But in terms of my equity market success in agency businesses, including insurance agency businesses, which I should know, I've been singularly unsuccessful there.
Interesting. I have a good friend of mine, a fellow Substacker. Shout out to Steve Farrington from the Unemployed Value Degen, a very smart guy. And he has explained to me that in the US, the baby boomers hold roughly 70 odd $trillion worth of household wealth. And he's got this thesis around the silver tsunami, with this idea that that capital is going to flow into certain industries. One would be insurance, life insurance, etc., buyback policies, and reverse mortgages. Have you played in any of those space? I think particularly the reverse mortgage is super interesting with someone who's accumulated a lot of household wealth, experiences inflation through their living costs, and decides to take out a reverse mortgage. And so I thought I would get your
Reverse mortgages are an important product for community banks in retirement communities. And so I've been an indirect beneficiary of the reverse mortgage business simply because I'm addicted to buying shares in well-run community banks. I consider a well-run community bank to be a bond portfolio that's underwritten by me, as opposed to by Wall Street, where I can understand the covenants and things like that. And as I say, reverse mortgage products are important products. The reverse mortgage products that are originated by community banks are often sold to reinsurance companies or insurance companies. So again, I've been an indirect beneficiary of that business. A prior bank that I was involved in, Everbank, had a very large mortgage business. We went from being nowhere in the mortgage business to being, I think, the 31st or 32nd largest retail mortgage originator in the United States, including reverse mortgages. So in that particular incarnation, I was a big beneficiary of the mortgage boom, generally.
Indeed.
I
And
think the crisis that faces the American mortgage industry is the increasing inability of young people without specific skills to buy a house, the increasing wealth disparity in the United States, where people who are employed in non-contestable businesses, people whose skill sets command a premium in today's economy, are having no problem buying houses. But that percentage of the overall population is declining. And the volume of real estate transactions that we enjoyed in the decade of the 90s when interest rates were falling, even the decade 2000 to 2010, when interest rates were falling and the mortgage industry benefited from the refinancing boom, is something that, with the interest rates wanting to go higher, assuming that the Fed can't interfere, that and the general lack of affordability for 50% of the population means, I think, that the mortgage industry, with the exception of the reverse mortgage that you described, is an increasingly challenged industry.
okay. And with your Battle Bank shirt on, it sounds like offering mortgages won't be a primary focus of Battle Bank. Is that correct?
Mortgages weren't a primary focus of Everbank. It's just that, we developed this huge deposit business by offering people deposits in foreign currencies and, frankly, treating them well. We didn't have 16 US dollar deposit products. We had one. We had a high yield money market fund, and we allowed people to earn money in their checking account. Because we treated people well in deposits, they started saying, "Hey, do you guys do mortgages?" And in the beginning, we said, "Yeah, of course we do mortgages." And after about 3 weeks, "Oh, we specialize in mortgages." Our cost of capital acquisition, customer acquisition in the mortgage business was nil, because we marketed to people who were already depositors. At Battle Bank, we should dial back. At Everbank, when we opened it, our customer backlog, the people in our mailing list, was zero. At Everbank, our customer backlog approaches 17,000. I suspect that as a depository, we will grow extremely rapidly. And if, as a consequence of that, we are able to serve our customers better, we will develop a mortgage business simply because people would rather deal with us than our competition.
Yeah, well, I'm one of those 17,000 on the waiting list, so I can't wait for day one. I'm super excited about the prospect. Let's talk about something else that's exciting, but a little bit more on the scary side of exciting. The two most terrifying words in English, possibly private equity, Rick. I'm not sure if you have ever invested in some of these publicly accessible private equity firms. I'm thinking of, let's say, Brookfield in Canada. I looked at them. I thought they were trading at a discount to some of their hard assets. I passed, and now, of course, the stock is up like 50% since I looked at them. Do you own any of these private equity groups?
I no longer own Brookfield, but I was a Brookfield shareholder for many, many, many years. I knew and have known a lot of their management team, including the guy who was effectively the founder of it, changed it from Brascan to Brookfield in Cockrell, and high quality people. The expectation for success got too high, and I think the company got too large and too diffuse. So I lost my courage and sold it. I briefly owned Icon Capital, Carl Icon's company.
Okay.
I got shaken out of that because his willingness to use leverage exceeded my ability to endure it. And he turned out to be right. I turned out to be wrong. He's a very clever guy. He's made a lot of money. But I wasn't willing to operate or contribute to the thin equity slice that he was using in his transactions.
Yeah, what's that saying that Warren Buffett says about they're called private equity, but they should really be called private debt institutions?
And the private debt business has been very good to me as a private lender. That's been an extremely good business to me. It's become a fairly crowded space simply because the returns that some of us enjoyed in the decade of the 1990s and the 2000s attracted a lot of tourists. Back in the days when Murray Sinclair and I founded Quest, which was a private lender in the mining space, now owned by Sprott, we were effectively the only lender to the junior mining space. That was wonderful market share, 100%. And the pricing, let's just say that the pricing reflected our market share. Later, some of your mates, Macquarie, came into the space. They didn't come down as far as we were. But the truth is that success attracted a lot of very high quality competition. That business, Quest, is now owned by Sprott, and so it's a sort of a $2 billion business. But there's Taurus in Australia, Orion. That private debt business has become very crowded. Unfortunately, in mining, unfortunately for me, it's crowded with very high quality competitors. I wish it was crowded with morons so that I could compete more actively.
Yeah, it just seems, I don't deny that the private equity business model from the fund manager or from the general partner in the US's perspective is extremely attractive. I wrote a piece on Digital Bridge, License to Deal or Steal was the title. I mean, just an amazing business. The fee equity under management was like 34 billion. 340 million of fees was generated, and that's sort of 1 and 20 carried interest. But only 78 million actually passed through to the shareholders. Did it ever take your fancy to start a private equity or an LBO type management or partnership in the US? It would be.
I got to know those equity bridge guys, and they're smarter than me. I wouldn't want to be competing with them. They're really, really, really high quality people. They're also younger. They have more courage. And trying to compete with somebody who is at once smarter and more courageous than you is a tough way to make money. I'm very impressed with those guys to the extent that I don't want to get in their way. When I was managing other people's money, there was a couple things I was good at, one of which was private debt in the resource business. That was helped by the fact that, I was one of the few guys in it. That really did make life easy. In the middle part of the decade of the 90s, all the way through the middle part of the decade of the 2000s, I was also in microcap resource equity management. And again, there were no players, or very few players. There were almost no players that commanded $100 million in the microcap space, but I did. And capital was extremely scarce then. The mining industry says capital is scarce now, and you can't get a warrant on a financing. That's not an example of a market where capital is scarce. In 1996, 7, 8, all the way through really 2004, there was no discussion of a financing that didn't include warrants. And I got warrants not just from the Three Stooges. I got warrants from the Lundins. I got warrants from Robert Friedland. I got warrants from Ross Beatty, Owen Haggerty. It was an easier time to be a specialized asset manager. The other thing that happened is, for myself personally, I got to a certain point in time, a certain age, where I didn't want to manage other people's money. I have one client now. He's a bit of a jerk. His name is Rick Rule. But I know him pretty well. He expects some mistakes out of me. He's seldom disappointed. We think similarly. He's really easy to service as an investor.
Well, it all sounds good as long as your only client doesn't fire you, Rick. That's when you get into real trouble. I saw, I believe it was in the Rule Classroom, an interview with the Dundee Corp. Very interesting way to play some of the financing and the natural resources. What's so attractive to you about the Dundee Corporation, and why should investors be paying more attention?
Well, the first thing is that I've done business with the Goodman family for 4 decades. I did a lot of business with his dad. and his dad was one of my early mentors. So I've known Jonathan since we were both in our 20s. He's a very known item to me. My former business partner in lending, Murray Sinclair, was on their board for years, so I watched them up close and personal. My first experience with them was when the original merchant bank, Dundee Bank Corp then, was spun out of Corona when Corona was acquired by Homestake. The mining investors didn't want to own a merchant bank, and so they sold it off to the point where it was selling at a third a book. So I got a very smart investor, Ned Goodman, that had a sole franchise. Nobody else was doing it. And I got it at a third a book. Managed to buy a fair bit of that stock below $1 Canadian and watched it go over 5 or 6 years to $40. Did I own all of it all the way? No, of course not. But I had a good taste in my mouth from it. Later in life, Ned Goodman unfortunately became senile while running Dundee Bank Corp, which didn't lead to all good outcomes. His son had to take the business over, and they had to go through four or five very hard restructuring years. When that job was done, the investors were out of patience. And so you had a battle-tested team who did fantastic due diligence. I mean, Julian Barnes is a superstar, as an example. And you got him for half nav. What Jonathan does is precisely what I did in the 80s and 90s and 2000s. But I don't have to do it anymore. He does it. He goes in and takes big positions in companies, provides adult supervision if he has to, teams up with institutional investors to thank and excuse management teams that need to be thanked and excused, but otherwise works with them and facilitates their success. They bring more than money. And importantly, he does the work. I don't have to. I often co-invest with them. I've watched their due diligence process up front and, up close and personal. And I really got a chance to watch the process at Reunion, a company that I was invested in, and they became the largest shareholder of. And I watched them be the shepherd of Reunion, through discovery to delineation to pre-feasibility study to feasibility study to construction finance to acquisition. I watched them as full cycle investors, and I was very impressed with what I saw.
Interesting. And in terms of natural resources, last we spoke about uranium and around gold mainly. Agriculture seems to have been a really tough gig for some reason over the last few years, and yet seed or feedstock processors would appear to me to be somewhat of a toll booth operation. Do you own any of these types of companies? Like I'm thinking Archidaniels Midland, there's Bunge, those types of guys.
Bunge I have owned from time to time. When you get to ADM, they become partially a branded goods marketer. And again, my track record of success in branded goods marketing, I wouldn't want to impose that on anybody else. I have been a farmland investor for years, including in the equity markets and including in Australia, back a long time ago. And I continue to be a farmland investor today. Unfortunately, I'm not alone in that. 10 years ago in the United States, farmland was stupidly cheap. I was, even 10 years ago, too old to try to operate a farm or stretch fence. But I was not too old to allocate capital to young, aggressive farmland acquirers and leasers. The cash yields on farmland have fallen to the extent that I'm no longer a purchaser, but I haven't sold anything.
And one of the main inputs if you're farming is fertilizer, and an input to that, if it's ammonium based, is natural gas. Natural gas was criminally cheap, and it still is if you ask some people, over the last few years. We expect, I read last night, roughly 25 to 30 billion cubic feet to come online just in the USA over the next 18 months of export potential. And some people are saying we might be looking at a double in terms of the global gas pool and demand. Where in this value chain from sort of upstream through to liquefaction do you think represents the best opportunity in the gas market today?
The part I understand the best is exploration and production. That's where I have the best competitive advantage. My suspicion is that the best risk to reward occurs midstream. The gatherers and processors, The LNG space seems to be falling into the hands of the Brookfields and the Cheniers, where the great big infrastructure companies are important to the space, but the space isn't important to them. In other words, they're all indirect plays. We've seen a real improvement in U.S. natural gas prices, albeit from ridiculous lows 24 months ago. So some of the leverage that you would have expected to see in the users of natural gas will begin to disappear because the feedstock prices have doubled, the Methanexes of the world. Longer term, I think you still do well upstream. The people like Devon, Equitable, up in Canada, Peyto or Birchcliff, the people who are making money at $1.50 US 1,000 are making a lot of money at $3.50 a thousand. And they seem to be able at once to generate enough cash to make sustaining capital investments and continue to distribute cash to shareholders by way of buybacks and dividends. A very sweet spot. I don't think that we're going to see the percentage moves in 2025 that we saw in 2024 in Devon or Equitable or Peyto or Birchcliff. But you shouldn't expect 50% moves every year. I guess the easy money has been made, and perhaps the certain money is ahead of us.
Yeah, especially with the sizing of some of those companies, a 50% move would be asking quite a lot.
Yep.
You're familiar with Cheniere, you know the company very well. Roughly 18 months ago, I asked you about a company called New Fortress Energy. Now, that has exhibited 50% moves, but unfortunately in the wrong direction
Right.
from my perspective. Have you taken a look at New Fortress Energy since?
I've not. I've not.
Fair enough.
There has been so much money to be made in the big names in oil and gas. And I've been, frankly, so preoccupied with building a bank. My willingness to come down the capitalization table chart too much in energy hasn't been there. When it looked to me in 2021, it looked to me like Exxon was a quadruple. And I'm thinking, so explain to me why I should mess with too much else. 2021, briefly, Exxon sold at an 11.5% yield. One wonders why I did anything else.
It's true. Yeah, when you put it like that. Gas, electricity, and water shortages, given the data center rollout, is something that I'm following. Data centers used, according to what I've read, nearly 28 gigs worth of power and 163 billion gallons of water in 2024. They tell me that's about 10x the requirements of the city of LA. Have you got water, Rick?
I was a water investor a long time ago. I have a great pun about that. It turns out that in terms of investment vehicles, water is very illiquid. It is difficult to invest in. I was a water rights investor. And it turned out that my timing was pretty good. What I thought would happen is that there'd be a drought and there would be some deregulation with regards to water utilization. In California, as an example, about 85% of the water that's used is used by agriculture, which contributes 2.5% of GDP. And there are laws in California that go all the way back to the time chronicled by Chinatown, when the legislature in California protected agriculture and made it impossible to void, which is to say use agricultural water for commercial and residential purposes. I thought that the taxpayers and the voters would change that. They didn't. What happened to me is that the rents that I enjoyed on the water I owned went up, and other strategic buyers came into space. But there's no room in the water business for a guy like me anymore. There are very few publicly traded water companies. Australia is different. You can go to the Darling Basin and buy and sell water rights in Australia. The best water law in the world is in Australia for investors. But in the rest of the world, that doesn't exist. The way you play the game in the United States is to buy companies like Limonera or Boswell, farming companies that own a lot of water rights pertinent to the land that they own in fee for agricultural purposes. That's treated me well too, but they're not pure play water companies. Boswell is an example. Rise and falls partially due to its success or failure in developed real estate, and also due to the cotton price. Limonera, the future of Limonera probably won't be determined by their water rights, but rather by the fact that they have, if my memory serves me well, 2,200 acres in Santa Paula, California, where over time they'll develop a town. So it's less of a water play and more of a developed real estate play.
It seems to be so attractive and yet so tricky to truly express that thesis. We're coming up in what I call shoot from the hip time. Thank you to everyone who's put through your requests. I won't be able to get through all of them, but Rick, we've got a mix of names that viewers would like your take on, starting with EMX.
Eurasian Minerals, disclosure of conflict of interest. I'm a big shareholder, and I'm the founding shareholder. I wrote check 1 back in the Paleolithic when the rocks that they explore for now are being formed. I was writing a check to own the stock. EMX is run by a very competent guy named Davey Cole, and he has a great team. The chairman of that company, Michael Wynn, used to work for me. I joke that he's well brought up because I helped bring him up. They are great prospect generators. They have wonderful minds. They're good investors. Importantly, they have a fairly small, I think 0.5% royalty on an extremely large discovery called Timok in Serbia, being built by Zijin. Zijin isn't talking too much about their new discovery, but satellite imagery suggests they have either 11 or 12 rigs on it, which would suggest that they're onto something. The other thing about EMX is, although they're a fairly small company, they're actively buying back stock. There's two kinds of companies, really. There's companies that think that the money is worth more than their stock. They do underwritings. And there's companies that think that their stock is worth more than the money. They're spending the cash that they generate to buy the company in. I prefer the latter to the former. And EMX is doing exactly that. They're fairly aggressive in their stock buyback for good reason.
You have it. One that's been a little volatile, starting to hit its strides now, Sandstorm Gold, SAND.
I'm a Sandstorm holder. I'm probably the only person in the world that wishes they hadn't spun the copper assets out, but they did. That company was penalized rightly because they were aggressive buyers of stock, and then they needed to issue shares to raise money at a price that was less than the price that they had spent to buy back shares. Negative financial engineering. The balance sheet was also very bad. They're beginning to fix that. There's a lot of cash coming into the company. And if you look at the net debt plus cash on the balance sheet's much better. Meanwhile, some of their legacy assets are moving to production. That's a fairly cheap company. And when you look at the valuation discrepancies in the royalty market, which is to say the biggest and the best royalty companies selling at 2.5 times NAV, and companies like Sandstorm arguably selling at 60% of NAV, if the market doesn't arb away those valuation discrepancies, my suspicion is that somebody like Franco or Wheaton uses their low cost of capital to change the cost of capital by Sandstorm by simply gobbling them up.
Seems highly likely. BT Gold is the next on the list.
I don't know it.
Not
B2, not B2, not BTO.
It could be. I think it's BTG is what I've been given by the questioner. Perhaps they did mean B2 Gold.
If that's B2 Gold, the recent press release they had concerning the project in northern Canada is concerning. I had understood that the project was behind schedule and over budget. The reclassification of the reserves, in particular the deletion of most of the proven category, is problematic to me. I have a high regard for Clive Johnson, who runs the company. I've known him for 45 years. I have a high regard for the team's ability to build mines in remote locations, Siberia and elsewhere. I'm concerned about the latest press release.
Altius Minerals.
I love Altius. I wasn't shareholder 1 there. I think I was shareholder 5, which means I go back a very long time. Brian Dalton, I was going to call him young Brian Dalton, but he's not young anymore. I've known him for 25 years. Brian Dalton is one of the best asset allocators in the business, completely untroubled by fad. He's done a miraculous job, and I trust him to keep doing a good job. I think he's got at least 10 or 15 more years in the saddle, which is wonderful. The senior management team, despite the fact that chronologically they aren't old, have been on the job together for 25 years. It's a team that's gelled. They're generating really, truly substantial free cash. And they can be absolutely counted on to reinvest that cash intelligently.
Many people wanting to know about recent results with Hot Chili Copper Company.
There's a lot about Hot Chili to like, starting with the CEO. A lot of people don't like him. I like him a lot. I think he's brilliant. I think he's tenacious. I like the deposit too. It's the 10th, 11th, or 12th largest undeveloped copper deposit on the planet, I think. Unlike a lot of Chilean deposits, it's not at 5,000 meters in the Andes. It's on the coast, or rather 30 kilometers in from the coast. The infrastructure is good. The Pan American Highway runs through it. Power runs through it. Water runs through it. It's next to a town that's full of these handy things called copper miners, if you're going to have a copper mine. And they have a new resource. They've been working for 20 years to get an entitlement from the Chilean government to access water from the Pacific Ocean. Having access to water in the driest place on the planet is potentially a very good asset. Now, they don't have any way for me to value this water asset yet. They're working on that. My knock on Hot Chili is that although it's a very large deposit, it is thus far of middling grade. And what I see missing here is the high-grade starter pit, which will allow the rapid recoupment of capital that increases the NPV of the project. I think it's likely they find it. They have something like 9 or 10 or 11 exploration centers in this camp. Well over 1 billion tons of ore. But, I haven't found in there the 50 or 60 million tons of 1% or 1.5% copper that allows the fast payback of capital. If they answer that unanswered question, the stock is gone. It either goes up or it gets taken over.
Okay. Adriatic Metals.
Adriatic's had some problems. I own it because I think they work through the problems. The style of mineralization, I'm reasonably convinced, is volcanogenic massive sulfide. There's some disputes about that in the industry. I think it is a VMS deposit, and I'm attracted to the fact that usually VMS deposits occur in clusters. It's arguable that they have 2 pearls on the string of pearls. Not unlikely, from my point of view, that they go to 3 to 5, which is to say I think there's a lot of exploration upside. The deposit at current metal prices is probably more a zinc deposit than a silver deposit, although I can't talk about $33.50 US silver because I haven't experienced it for that long recently. But I'm attracted to what they're doing. There's risk there. The mining code in Bosnia isn't very well developed, so there's lots of things that could go wrong politically. They had some technical challenges breaking the mine in. They had some political challenges getting part of their waste pad excised from the forestry reserve. That's, as I understand it, resolved now. But I think there's a political challenge operating in a frontier market that doesn't have a long established tradition of mining jurisprudence.
We've got 2 more, North Sea Oil and Gas and Sable Corporation. Very interesting special situation.
Don't know enough about either that my comments would have value.
Fair enough. And you mentioned answering the unanswered questions or the key questions. What's the question that I probably should have asked you today that I missed? Is there anything that I missed that I should have asked during our discussion?
Probably with every answer I give you, the correct counterpart is why. When I talk about the fact that I'm confident in an increased gold price, the idea that people should trust me, I'm too old to have much trust, So I like why questions with regards to gold. We've discussed it in the past, which is probably why you didn't ask me this time. But as an example, with the gold price, it seems to do well when people are concerned about the purchasing power of savings instruments denominated in fiat currencies. I think people have reason to be concerned about that. That's the why. I try, when I get an answer that's definitive, to say to the person who's answering my questions, "You seem awfully sure. Why?" And even if I get a good why, in order to prepare myself to use the information they gave me, I like to say, "Tell me 3 things that could go wrong. Make me know that you know enough about the topic. There's always something that ought to keep you awake. And if you don't know what ought to keep you awake, I don't really want to hear from you, you know?"
Mm.
And so if I had to restructure the way that you had interrogated me, I would have said, "Why do you think that?" Justify your assertion. And then I would have said, "So tell me what could make you wrong." Some of it I answered parenthetically, hot chili. If they aren't successful in developing a starter pit, then time value of money eats you up. You add more to your sea of mid-grade copper without being able to advance it to commercial production. We don't know what their seawater concession is worth because we haven't seen it. Is it worth $1? Is it worth $1 billion? I understand what could go wrong there, and I'm happy to talk to it.
Notes being taken. Rick, thank you once again for joining me. Pleasure as always. If people want to get in touch and learn more about Rule Investment Media or perhaps Battle Bank, how can they do so?
The easiest way is to go to my website, ruleinvestmentmedia.com, and I give you an incentive to do it. If you go there and you list your natural resource stocks,
Callie Ice 2.
I will rank them. Hold on 1 second.
No problem.
Hey, Callie, I'm on an interview. You need me now? No worries. I'll call you right back. Sorry about that.
No problem.
I will rank them 1 to 10. No obligation, no charge. That's Rule Investment Media. List your natural resource stocks. Please no pot stocks. Please no tech stocks. Please no crypto. The other thing is we have this thing called the Rule Classroom. Benjamin, I think you're familiar with it. We have a couple hundred hours of instructional programming almost every Thursday, assuming I'm available. We have a free question and answer session. We now publish a monthly newsletter at the Rule Classroom, which is absolutely free. And we have discussion groups around the newsletter too. The last issue was about Canadian oil and gas. But my granddaddy product, this one isn't free, is the Natural Resources Investment Symposium. I'm informed that it's 30 years old, younger than me, but still old. And it's a superb product. We talked about it earlier in this interview. Rulesymposiums.com, or you can ask me about it when you submit your natural resource stocks for ranking at Rule Investment Media. Suffice it to say, very, very high quality product. Whether you come to Boca Raton yourself or whether you enjoy it by live stream in the comfort and convenience of your own home, there's an ironclad, or I should say probably solid gold, money back guarantee. If you don't think you got your money's worth for any reason, email me. I'll give you your money back. Mercifully, in 30 years of money back guarantees, I've only had to refund about 0.1% of the tuitions that I've charged. But it is my guarantee to your listeners that they will enjoy full satisfaction. I hope everybody comes live. We have a great Australian contingent. Because of the performance of the Australian contingent at the bar, I'm able to keep the room rate at the resort lower than it otherwise would have been. So I expect you to hold up, your passport.
If they won't restamp me. They won't give me re-entry if I don't perform well at the bar, Rick. You know that.
I do. And so you'll be joined by, Kerry Stevenson and Shay Russell and some of your counterparts down under who have been loyal supporters of the conference, and a good broad range of Australian exhibitors where I'm a shareholder.
I certainly can't wait. Guys, links to everything that Rick just mentioned will be in the video description. Thank you very much for joining me once again on the ROI podcast. I look forward to catching up with you in another episode shortly. Take care, guys.